Hi guys, yeah, it's absolutely caning it down with snow, and I left Ashley Road in Poole at what was it, about 4:30. It's now 5:15, so I've been on the road for 45 minutes and I'm still on Ashley bloody Road. So what do you do when you're wasting loads of time sat in a car going at like 1 mile an hour? I thought during that time I'd try and give you guys some property advice, empty brain dump my thoughts, the stuff that's going on in the property world at the moment. Hopefully that will help you on your own journeys. So let's leverage this terrible time and see if we can get some value out of it for you guys. So there's always a common debate about what do I buy, what type of property do I buy, where do I buy, should I be concentrating on yield, or should I be concentrating on capital growth, or should you try and find a mixed balance between the two? That is a big subject, but let's just focus on the capital growth bit for now. Now, if you're looking for good capital growth, a lot of people go, oh, look, you just buy in a really good area. Well, you know, all of Poole and all of Bournemouth are really good areas in comparison to many. But if you actually break down the postcodes, break down the conurbations, break down the roads, and then break down the property types within those roads, so, you know, flats, semis, terraced, detached, bungalows, flats, whatever, all the different property types, then in those specific locations it makes a massive difference to capital growth, because ultimately it comes down to supply and demand. So if you're talking about buying a brand new 2-bedroom flat in the centre of Poole, and it's 600 to 800 square feet, well, if you go on Rightmove and you search for that type of product, you'll be spoilt for choice. You know, there's always loads of those, 50, 60, 70 of those for sale at any one time. So you can imagine if you've got that many for sale, and when you measure buyer demand, there isn't 40, 50, 60 new buyers willing and able to buy that type of product in that specific location every month. And because of that reason, capital growth will be stagnated. You know, despite what the market does, despite, if you see the headlines going, property prices in the UK on average went up by 8% again this year, or 6%, 10%, whatever. That as an average, that figure is no good to you. You have to absolutely drill down property type and specific location to get a true figure. We've got I used to do it myself in the office, spent hours and hours and hours and hours analysing all the data for all the conurbations of Poole, BH1, all the way through, property types, all within each of the roads, to get an accurate assessment of the capital growth over the last year, 3 years, 5 years, 10 years, looking at what's changing in the future and forecasting what would be the best hotspots to invest in Bournemouth and Poole, Wimborne, Christchurch, all around here within the next few years. But we've got a team now in house that do all that data. Saves me that bother, and I can now just spend the time casting my eye over it and advising clients accordingly. So I've outsourced that bit, which outsourcing for anybody is a really important thing to do to maximise the efficiency of your time and value. So getting back to where and what you buy, capital growth, very important. So if you were to buy one of those flats, you might expect that in 10 years time that flat price might have doubled, but if there's less people that want to buy there against the amount of people that are selling there, that ain't gonna happen. You'll be lucky if it's moved at all. There's pockets of Poole and Bournemouth where 15 years ago the prices are still the same. Contrary to the popular belief that house prices double every decade, if you go back to 1950 and you get till now, yes, they have. They've doubled about 22 times. If you look in the last 10-year period, no, it hasn't. Some areas, let's say for example Blackpool, they had a big old drop in prices in 2008 because in this last isolated decade we've had a recession. So Blackpool, they had a big old dip. Can't remember what it was now. I think it was about 20-25% drop, and they're crawling their way back up, and we're now 10 years down the line, and they still haven't caught up to what it was in the peak of 2007. You know, they're still about, I think it's about 14% below what they were in 2007. Whereas Bournemouth and Poole, we got we crawled back to 2007 levels by about 2013. So, but we didn't drop much. We dropped about 5% on average. So we didn't have anywhere near as a big hit, and it took us a lot less time to get back up to the peak level. But now we've way surpassed it. It's very property area specific and property type specific. So there are certain products in Poole and Bournemouth, as I was just saying, that they've only just today in 2018 recovered to what they were in 2007, and they haven't had any growth. But you could cross over the road in the same road and see a terrace house that's gone up 30-40% since then, and that's because let's take Canford Heath, Oakdale, Upton, those types of areas. Everybody wants a 2-bed house, semi or terrace, or a 3-bed. Two and 3-bed terraced and semi-detached houses in those conurbations of Poole. Every bugger wants to buy one. So, but when you go on Rightmove or Zoopla or Prime Location, whatever you fancy, there isn't anywhere near on the market the amount of people that want to buy them and that can buy them. So that is very important, and that's why you've seen, you know, your 2-bed semi or terrace house in let's say Canford Heath go from sort of what 160, 170 grand back in sort of 2009-10, and they're now 100 grand more than that. You know, whereas the flats at 110, 115, yep, they're about 120, 125 now. So they've gone up 10, 15,000 quid, but the house next door has gone up 100 grand. So, you know, when you're thinking, oh, shall I go for the flat buy-to-let to get a 6.5% rental income yield against the house that's going to cost me more money, more deposit, and I might only get like a 3.5-4% yield. But that 1 or 2% yield difference is absolutely smashed up by the capital growth of that freehold unit that everybody wants to buy. So if you went over a 10-year period and thought, well, I'd make 150, 200 pound a month more by having the flat, so that's 2.5 grand a year more, best case scenario. Is that right? Yeah, couple hundred quid a month, 2,400 a year on a flat over 10 years, 24,000 pounds over 10 years, say in more rent than the house. But the house has gone up 100 grand in value against the flat at 10 or 15,000. So the freehold house, 2-bed or 3-bed terrace or semi, has beaten up the flats in terms of capital growth versus yield. But it doesn't always work out like that. You've got to absolutely know your patch inside out. You've got to know the property types, the roads, you've got to know everything that's going on. You've got to know the rental values, the house values, the demand, the ratio of that between what's on the market at any one time and how many people are looking, to actually know this stuff. But that's why I'm here. That's why, you know, Embark was established, because we're here to help sophisticated, you know, property investors and developers do this right. I got it wrong the first time. I absolutely ballsed it up, you know, cocked it up royally, because I didn't know what I was doing, you know, and you know, and why should I? I wasn't expected to know what I was doing. You know, I was a lad in my late teens, early 20s, with, you know, big balls and no brains, just wanting to get into buy-to-let property. And, you know, you trying to work out what you buy, it was kind of like you'd go to estate agents and say, what do you think I should buy? And they were like, well, this is an ideal buy-to-let. Why? Oh, because it's new and you won't have to spend much maintenance on it. Terrible. That's not a good reason to buy a buy-to-let. In fact, it's probably one of the worst reasons. So, you know, I bought a number of properties, and when the recession came in, panicked, couldn't service the debt, had to panic sell them. So went from, you know, one small deposit to making, I can't remember what it was now, £500,000 worth of equity in a short time, to then losing it all, back down to about the one deposit again, all because I bought the wrong gear with no idea. So, but what a great process to go through to actually learn. And I think unless you ballsed it up and really had a go, and then looked back and worked out why, and gone as anal as I have, watch the pun, as anal as I, let's choose a better word, as intricate as I have in looking at trying to do it properly, that's how you really become really good at property developing and buy-to-let portfolio and understanding your marketplace. So very, very important on the capital growth element to fully understand if your proposed purchase is in a very high demand area for its specific property type. That is just one of the 3 capital growth rules that I use personally when deciding whether to buy a buy-to-let property. I actually want 3 things. I want a power triangle of capital growth, power streams of income, forces of nature to try and get that capital growth higher. So that is one, buyer demand and lack of stock for that product. The second one is pretty obvious. If you can buy the property below market value, then you're going to start on a positive equity creation from the point of completion. So easy maths, let's say the property's genuinely worth 200,000, not what it's on the market for, what it's actually worth. Let's say it's worth 200,000, and you manage to negotiate a discount and pay 180,000, let's say. Well, you got 20,000 quid of immediate capital growth. You've created the capital growth immediately on acquisition. You haven't had to wait for it to go up, you've made it. So I like to do that at the beginning because that's a nice financial buffer. If the market did go down for a little period of time, well, I've probably buffered that and got that in by getting the property at a bit of a discount. That's lovely to be able to do that. In buoyant markets, quite tough to do that, but always have a go. So that's the second part of the capital growth power triangle. The third one is finding something that does have the ability to add net value. So I'm not talking about where you buy something and it needs a bit of work and you do it up, because contrary to popular belief, again, it is very difficult to actually make that work in net value terms, because quite often the case, people think they've made money by doing a property up, but they actually haven't, and I'll explain that. So they they would buy a property, let's say for £200,000, and they spend £20,000 doing it up. So they've changed the kitchen, they've changed the bathroom, they put new carpets, painted the walls, had a house painting party, lovely job, and quite often the case, what they've actually done is just add £20,000 worth of value to the property. So they bought it for 200, spent 20,000, now it's worth 220. No one's made any net value add there. But people don't look at it like that. They do that work and they live there for a few years, and then they get an estate agent round. The estate agent says, "Oh, do you know this is worth 250," and then they say to their mates, "Do you know what? We bought this for 200, spent 20k, made it worth 250, made 30 grand by doing it up." No, you didn't. The market went up 30 grand. If you hadn't spent a penny on it when you bought it for 200, it would have been worth 230 grand by the time the agent valued it anyway. So just because you've put 20 grand into it, it's just made it worth that much more. So that's a common myth. People think you can just go around buying properties, changing the kitchens, bathrooms and carpets and decor and making money, but 9 times out of 10 it isn't the case. To actually make a net add value in a property, you have to change its accommodation type. You have to turn it from a 2-bed to a 3-bed. You have to turn it from a 1-bed to a 2-bed. You have to knock through a wall to make the crap kitchen and crap dining room in a big, lovely kitchen diner. You could go up, there could be a double garage on the side, and you could extend over the top of the double garage and turn it from a 3-bed to a 5-bed. It might cost you 25-30 grand to do that, but you might put 60-70 grand on the value, because now that's what 5-bedroom properties sell for in that road. So you have to do a lot more, I'm afraid, than tickle a property to actually get a net value add on it. But if you do, whoa, Nelly! Nearly slid into the car in front of this ice. So what I'm getting at is, if you can find that property that has, it's in an area and it's a property type where there's a starving crowd for that property type, and it's going to have awesome capital growth compared to properties and locations around it. Beautiful. You've ticked box 1 of that power triangle. Oh shit! There's a bus in front of me, all the way along the side of the road. Hold on, guys. I'm going to have to very carefully go around this. Right, back to the property talk. So that's power 1 of the capital growth triangle. Number 2 was BMV, standing for below market value acquisition. So buying something cheaper, like I said, something worth 200, you go and buy it 180 or 185, immediately make some capital growth from day 1. And the third one was finding a property with genuine net value add capabilities. For you starters out there, oh, what's happening here? They're telling me I can't go down this road. We'll see about that. It put me off. What was I saying? Oh, is this chap gonna have a word with me? Go this way. What's happening? Can't go that way, no?
Well, you can. You get stuck. Which way? Do you know where you're trying to get?
Broadstone.
Broadstone.
Yeah.
Back.
Ringwood Road. So down there. Yeah. Turn right. Yeah. And then Dean Court Road, another right. Yes, I know where. Tiny roundabout, which you probably just came through.
Now you know.
No worries. Thanks, buddy. Yes. So something where you can add net value. And what I was about to say was a really good starter one for people is to try and find 1-bed flats that have got a really big lounge. And I'm talking, the lounge needs to be, to be honest with you, at least 15 square meters. You know, so ideally a bit bigger than that. But you know, if it's say, let's say the living room's 4 meters square, so it's 16 square meters, then you know there's a good chance you could stick a little kitchen in the corner of the living room and it'll still work. And then the old kitchen, as long as it's got its own window in it and it's big enough to put a bed in and a wardrobe and bits, then that can become bed 2. So you can buy a 1-bed flat with a good sized lounge, stick the kitchen in the lounge and turn it into a 2-bed flat for relatively little money, probably about 10 grand by the time you've moved the services, moved the kitchen, etc. But if you can buy a 1-bed flat for you know, 160,000, 150, 160,000 in a good area, turn it to a 2-bed for 10 grand and then make it the 2-bed flat might be worth 190 or 200,000. What a great way to really add some net value. And you know, you don't have to do that. You know, you can do other strategies. You could buy let's say a 3-bed terrace house semi, and you could change its use. You wouldn't actually have to make, turn it into a bigger version of itself. You could just change its use. So you could perhaps convert the garage into a room and the loft into a room. So now you've turned a 3-bed semi into a 5 or a 6-bed semi, and then you change its use from C3 residential, which is where people live in homes, to C4 home of multiple occupancy. And then you could rent the property out by the room, which creates a huge income, and it puts decent value on that property as well. Probably worth more, well, it's certainly worth more than what a 3-bedroom family home would be. So if you can tick those 3 boxes and get a power capital growth triangle going, well, you ain't going to go wrong. No bloody way. And if you can combine that with something with a good yield, like I said on that last example, if you were to buy something that was C3 use, like the 3-bed semi, and turn it into a C4 home for multiple occupancy, not only have you got that 3 triangle capital growth power triangle, you've also got something high yielding, probably somewhere to the tune of 8 to 10% in the Poole and Bournemouth area, sometimes more depending on the deal. Now that's the sort of, I was going to swear that, that's the sort of gear I like to buy and I like to help my clients buy, not these plain vanilla investments where they don't really do anything and you're just purely relying on luck and hope that it's going to go up. You need assets to be able to support themselves, and you want them to be able to grow at a much higher rate than the others in the area. So, and it's not, this isn't luck. I know there's no such thing as a risk-free investment, but you can significantly increase the chances that the investment is going to go much better if you look for these type of things. As I say, even if you didn't bother with finding something that you could buy cheap, BMV, even if you bought something that couldn't be have value added to net added value to it, even if you just got the first 1 point of the triangle, which was buying a product in a road with a starving crowd where capital growth outperforms any other asset class in that time, well, that's better than just going to buy something that you haven't looked into and it's just going to stay at the same value for the next 10-20 years, and you're going to be pissed off you bought it in years to come. Even if you get that one bit right, it's better than doing the alternative. So yeah, don't go and buy anything without working that out, and that's what Embark's here for. Give us a ring if you've seen something and you want some independent, unbiased, true advice. Give the guys a ring. They all know what they're doing. They've been very highly trained compared to your typical estate agent, who are some are very good at selling family homes, etc. But when it comes to investments and buy-to-let and land, you do not go anywhere else apart from Embark. We are the unrivaled experts, if we don't say so ourselves. Head exploding out of the cart. No, we really are. This is what we do. We don't do anything else. We all our time and focus is becoming experts in that field. That is our niche. You don't get one solicitor saying, tell you what, I'll do your house conveyancing, I'll sort out your divorce, and I'll get your wills and probates. No, you have a solicitor specific for each of those things, because they've got to specialise in each element of it, of law. Estate agents just tend to have a go at anything, most of them not very well. We have picked investments, buy-to-let, developments, things that investors and developers and landlords want to specialise in. So that's who you go to, guys, if you're in that world. So anyway, I'm going to have to concentrate now, because I'm coming up to a very busy chaos roundabout, and I should probably pay more attention. I'm checking out. I hope this 24-minute video has added value to your property journey. I hope I haven't wasted your time. Otherwise it would have been completely wasted, sat in this car on my own doing bugger all. Speak to you again soon. Ciao.